The year is 2000. The NASDAQ crashes 78%. A lot of folks had their life savings vanish. And the worst part is, it didn't happen slowly. It happened fast. A lot of people thought they were diversified. A lot of people thought they were long-term investors. And then reality hit. Now fast forward 25 years later, and people are asking a similar question. Is AI the new dot-com bubble? And here's the thing. I'm not here to predict a crash. I'm not here to tell you that the market is about to collapse and that you should be buying up gold and stuffing money in your mattress. What I'm here to tell you is that all this matters a lot more if you're retiring early. If you retire early, the market doesn't have to crash for you to have a problem. It just has to fall at the wrong time. So in today's video, I want to show you what actually happened during the dot-com crash, why it was so brutal, and then I want to walk you through the early retiree playbook for what to do right now while markets are near all-time highs, and what to do if a big sell-off actually comes. By the end, you'll know how to position yourself whether AI stocks keep soaring or whether you see a major correction. Quick reminder, my name is John Boyd. I'm a certified financial planner, and I'm the founder of MDRN Wealth. If you're working towards early retirement and you want help building a plan that accounts for taxes, cash flow, and market risk, go ahead and scan the QR code or click on the link in the description for a free retirement assessment. All right, guys, so let's dive into it. The dot-com bubble burst between 2000 and 2002. And it followed a huge rally leading up to it. The NASDAQ Total Return Index fell about 83%, and it didn't recover from its previous highs for 15 years. I'm going to say that again, 15 years. That is the part most people don't understand. Most people nowadays think all market crashes are like what we saw in 2020, where markets crashed, but we got a recovery in about 3 months. The problem here wasn't just that it dropped. The problem is that it stayed down long enough to destroy retirement plans that weren't built for it. If you're 35 and still working, that's painful, but you can recover. You can keep contributing to your retirement accounts. You can keep dollar cost averaging. But if you're 52, 55, 58, and you're living off your portfolio, this becomes a completely different game. This is called sequence of return risk, and early retirees are the group that is most exposed to it. So what are the lessons here? In my opinion, there's 3 big takeaways from the dot-com crash that matter most for early retirees today. The first lesson is that concentration can quietly build up without you realizing it. During dot-com mania, everyone crowded into tech stocks. Tech became about 40% of the US stock market. Diversification disappeared. And when the bubble burst, concentrated portfolios were absolutely decimated. Now today, we don't need to debate whether AI is a bubble, but we can acknowledge something that's objectively true. Market performance has become increasingly concentrated. The Mag 7 represent roughly a third of the S&P 500's market cap. And the returns of those companies have driven a huge percentage of overall market gains. That's not just a prediction. That's just the environment that we're in. It's just the reality. So if you are retiring early, one of the most important things you can do is check whether your portfolio is unintentionally overexposed to one sector, one theme, or a handful of companies. And this leads directly into the first part of the early retiree playbook. If markets are at all-time highs, this is the time to rebalance. Rebalancing sounds boring, but it's one of the most important risk management tools that you have. Because if you wait until after the crash to rebalance, you'll either be too scared to do it, or you'll be forced to sell something at a really bad time. So the first move is to rebalance now while it feels easy. The second lesson from the dot-com bubble is that patience is not optional. A lot of people were right about long-term potential of the internet. They were just wrong about the timing. And this is where early retirees need to think different than everyone else. If you are retiring early, you don't just need long-term growth. You need a plan that works if markets go sideways for years. If you want to retire early, you need a war chest. And when I say war chest, I'm talking about 5 to 7 years of spending reserves. Now, let me be clear. I'm not saying that you should hold 5 to 7 years of spending in just straight cash in a checking account, but you should have 5 to 7 years of spending assets in something that's not going to drop 50% when the stock market drops. This can be a mix of cash, short-term treasuries, high-quality bonds, and other really stable assets. And here's why. During the dot-com crash, it wasn't just a one-year event. It was a multi-year drawdown, and the recovery took 15 years. If you're pulling from stocks during a multi-year drawdown, you can permanently damage your retirement plan, even if the market eventually recovers. So the war chest isn't about trying to time the market. It's about making sure you aren't forced to sell your stocks at the worst possible time. Early retirement without a war chest is not confidence, it's exposure. And if markets are at all-time highs, this is the time to build it. The third lesson from the dot-com bubble is that investors who survived weren't the ones who predicted the crash. They were the ones who had a plan during it. In that period, certain areas held up much better. Value stocks, so these are like your dividend stock type of names, did better than growth stocks did. Defensive sectors did better than tech. Heck, international markets, which a lot of people tend to blow off, did substantially better than US markets for most of that entire decade from 2000 to 2010. And bonds provided a major stabilizing force as investors fled to safety. Now, the point of that isn't to say go buy dividend stocks or go buy gold. The point is that diversification and rebalancing mattered. And for early retirees, this is what the crash plan looks like. If a major sell-off comes, you don't panic. You don't sell your best assets because you're scared. You do two things. The first thing, if you're able to, you buy into the crash. Now that sounds simple, but most people can't do that emotionally. The reason early retirees can do it is because they have a war chest if you play this right. They have reserves. So instead of selling stocks in a crash, if you play this right, they can spend from stable assets during that period of time and at the same time selectively rebalance into stocks when prices are down. That is one of the most powerful advantages you can build into your early retirement plan, is giving you that type of flexibility. The second thing that you can do during a crash is Roth conversions. And this is where early retirees have a huge opportunity. Because when markets drop, your IRA balances are going to drop too. And that means you can convert shares into a Roth at a discount. You can pay tax on a smaller value. And when the market recovers, that recovery happens inside of the Roth account. This is one of the few times where volatility can actually create opportunity. A bear market is the only time the IRS gives you a discount on Roth conversions. But here's the catch. This only works if you've built your plan correctly. If you have no reserves and no taxable funds, you can't pay the tax on the conversion without pulling from your IRA, and that completely defeats the purpose. This is why the war chest matters. This is why the brokerage account that I've mentioned in other videos matters. And this is why early retirement planning is not just about your withdrawal rate. It's about how you structure your account so that you can survive volatility without being forced into bad decisions. So let's summarize the playbook real quick. Number one is rebalance now while markets are high so that you're not accidentally overexposed to one theme. Number two is build a 5 to 7 year war chest so that you're not forced to sell stocks in a downturn. And number three is if the sell-off comes, you use that war chest to stay calm, buy into the decline through rebalancing, and potentially take advantage of Roth conversions while your account values are lower. The goal isn't to predict the crash. The goal is to make sure the crash doesn't control your retirement. If you enjoyed today's video, make sure to like and subscribe. And if you want help building an early retirement plan that accounts for taxes, healthcare, and market risk, scan the QR code on your screen or click the link in the description for a free retirement assessment. I hope you enjoyed it, guys, and I will see you next time.